Alert! $100 silver prices are imminent. This is big. While paper silver trades at $73 on COMEX, physical silver in Dubai just hit $127 per ounce. That's a 74% premium. Banks are scrambling, governments are hoarding, and the disconnect between what you see on screens and what's actually happening in vaults across 3 continents is about to expose the largest price manipulation in modern financial history. What happened in the last 72 hours changed everything. Welcome to Currency Archive. If you've built something in your life, if you understand that real wealth isn't measured in promises, but in what you can hold, then do me a favor, hit that subscribe button. We're not here for entertainment. We're here because the financial landscape you navigated for decades is shifting beneath our feet. And before we go further into what's unfolding right now, drop a comment. Tell me where you're watching from. London, Toronto, Mumbai, Texas? Let's see how global this audience really is. While most investors were watching Bitcoin and tech stocks, something unprecedented was unfolding in the precious metals market. Silver just crossed $94 per ounce. But that's not the real story. The real story is what's happening behind the scenes, in vaults, in exchanges, and in the widening gap between what traders see on their screens and what's actually available in the physical world. A financial analyst sat at his desk, looking at the charts with disbelief. Just 1 year ago, silver was trading at $30. Today, $94.58. That's a 215% increase in 12 months. He pulled up another data set that made his hands freeze over the keyboard. Silver had outperformed every major asset class in the past year, not just by a little, by a landslide. Silver up 155.8%, platinum up 137.8%. Gold, coffee, palladium, all trailing behind. For someone who had watched silver languish for the past 5, 10, even 15 years, this felt impossible. If you had told him 2 years ago that silver would be the #1 performing asset in 2025 and 2026, he would have laughed. But the numbers don't lie, and the question burning in his mind wasn't how fast did it rise. The question was, why is capital relocating here? Because metals don't move in isolation. They move with cycles, with capital rotation, with long-term demand. And silver sits at a very unique intersection. It's not just a store of value like gold. Silver is a monetary hedge and an industrial powerhouse. In 2025, the United States government officially added silver to the critical metals list. That wasn't a symbolic gesture. Silver powers solar panels, military applications, electronics, medical equipment. When governments start classifying something as critical, smart investors pay attention. They focus less on headlines and more on structure, supply constraints, time horizons. And right now, the supply constraints are becoming impossible to ignore. He opened another chart that had been circulating among serious metals investors, the gold to silver ratio. For decades, this ratio sat stubbornly high, sometimes reaching 100 to 1, meaning it took 100 ounces of silver to buy 1 ounce of gold. But in the first 2 weeks of 2026, that ratio plummeted toward 50 to 1, cut in half. Could it reverse? Absolutely. Could silver drop back down while gold surges, pushing the ratio back to 60, 70, or even 80 to 1? Of course. But the momentum behind silver right now suggests something different is happening, something structural. He clicked over to the COMEX data, and this is where things got disturbing. COMEX registered inventories of the actual physical silver available for immediate delivery had dropped over 70% since 2020. 70%. Gone. In just 6 years. And where did it go? It moved east. China, India, Dubai, Shanghai. The West has built its precious metals markets on paper, on futures contracts, on leverage. Meanwhile, the East has been quietly accumulating the physical metal. And now a dangerous disconnect was emerging. On paper, on the COMEX, silver was trading at 94, lower to 58. But in the actual physical market, closer to $170 per ounce, that's not a typo. That's not some collectible premium or numismatic markup. That's the real cost of obtaining physical silver in hand, right now, in certain markets. Most people don't understand this because they only look at the spot price. The spot price is set in the futures market, through financial contracts, not through actual delivery of metal. Real silver doesn't trade only on a screen. It trades in the physical world. And the physical world is sending a very different signal than the paper world. For years, the system worked because most futures contracts never resulted in physical delivery. They were rolled forward, or settled in cash. The entire structure was built on leverage, on fractional reserves. It's the same model banks use with deposits. They don't actually have all the money on hand. They assume not everyone will ask for it at once. But what happens when they do? What has changed in the silver market is simple but catastrophic for the paper system. More and more players are no longer satisfied holding a contract. They're standing for delivery. They're demanding the metal itself. And once demand shifts from paper to physical, real pressure begins to surface. That's why the COMEX is getting drained. That's why the CME had to increase margin requirements on silver contracts. They needed some type of control in the paper markets. But when the distortion between paper and physical becomes this extreme, when one market says $94 and the other says $170, the metal flows to where it's valued highest, and right now that's the East. China isn't buying silver contracts. They're buying bars, tons of them, and they're not selling. The registered inventories at COMEX, the metal actually available for immediate delivery, remain under sustained pressure. While open interest stays elevated, meaning more contracts exist than there is metal to fulfill them, physical delivery is drawing down existing stock faster than production can replenish it. And here's the problem. Silver production doesn't respond like a tech stock. You can't just scale up a mine overnight. To get a new mine operational takes years, sometimes a decade, permitting, exploration, infrastructure, refining, logistics. It's a slow, capital-intensive process. So when physical delivery suddenly accelerates, existing inventories get consumed, and there's no quick way to replace them. The analyst leaned back in his chair. He knew what was coming next, and it wasn't going to be pretty for anyone caught on the wrong side. The phenomenon unfolding in precious metals markets had a name that most casual investors had never heard of: backwardation. And it was flashing red across silver trading desks worldwide. In normal markets, future delivery costs more than immediate delivery. That makes logical sense. Storage fees, insurance, time value of money. But when a market flips into backwardation, when getting the metal today costs more than a promise to deliver it 6 months from now, that's not just unusual. That's a scream from the physical market saying we're running out. Silver had entered sustained backwardation, not for a day or a week, for consecutive periods, and seasoned traders knew exactly what that meant. This wasn't financial volatility, this was physical tightness. According to data from the Silver Institute, global demand had exceeded supply for multiple consecutive years. The deficit wasn't a one-time shock, it was cumulative, stacking year after year, like water slowly draining from a reservoir faster than rainfall can refill it. At first, nobody notices. Then one summer, the lake is half empty. Then 3/4 empty. Then, crisis. The silver market was approaching that crisis point, and the people who understood market structure could see it coming from miles away. One major bullion dealer in Dubai posted something that went viral among metals investors. He wasn't talking about spot prices or futures contracts. He was talking about what was actually happening in his shop. Physical silver products were being priced with premiums nobody had seen before. American Silver Eagles, Canadian Maples, generic bars, all carrying premiums of 40%, 50%, sometimes 80% over spot. In some Middle Eastern markets, physical 1-ounce silver rounds were changing hands at $127, while COMEX was showing $94. That's a 35% premium, not because of numismatic value, not because they were collectibles, simply because that's what it actually cost to get the metal. Two markets had emerged: the paper market, where contracts trade at $94, and the physical market, where metal in hand commands vastly higher prices. This divergence revealed something uncomfortable. Spot price reflects paper trading activity. Physical price reflects actual availability and supply stress. It's the difference between having a warehouse receipt that says you own grain and actually holding the grain in your hands during a famine. One is a financial instrument, the other is survival. And right now, institutions were quietly choosing survival. A name kept appearing in these discussions: J.P. Morgan Chase. For years, conspiracy theorists had claimed the bank was manipulating silver prices. But the reality was both simpler and more concerning than conspiracy. J.P. Morgan had accumulated one of the largest physical silver positions of any institution on Earth. Not through manipulation, through market structure. They simply understood something most investors didn't. When paper and physical markets diverge, the physical wins. Always. Throughout history, every time this pattern emerged, the paper system eventually capitulated, and those holding physical metal dictated terms. So, while retail investors argued about charts and technical analysis, J.P. Morgan quietly stacked physical metal, hundreds of millions of ounces, stored in vaults, waiting, because they knew what was coming. The question wasn't if the paper market would break, the question was when. And how violent would the repricing be? Some analysts were now publicly stating that silver's real price was north of $170, not as a future target. As the current physical reality, just hidden from view by the paper markets, think about that for a moment. If you're a pension fund manager or a sovereign wealth fund, and you realize the metal you think you own through futures contracts might not actually exist, what do? You stand for delivery, you demand the physical metal, And when enough players make that demand simultaneously, the fractional reserve system collapses. It's not a matter of if, it's a matter of when. The supply-demand imbalance was no longer theoretical. Mines couldn't increase production fast enough. A new silver mine takes 7 to 10 years from discovery to first pour. Environmental permits alone can take years. Infrastructure, roads, power, water, processing facilities. All of this requires massive capital investment and time. You can't email a mine into existence. Meanwhile, demand was accelerating. Solar panel manufacturing, electric vehicles, 5G infrastructure, military applications. Every major technological shift of the next decade requires silver, and not in small amounts. A single solar panel uses about 20 grams of silver. Multiply that by billions of panels in the global energy transition. One electric vehicle uses nearly twice as much silver as a traditional car. 5G base stations require significantly more silver than 4G. Medical applications, water purification, antibacterial coatings. The industrial demand alone was staggering. Add in investment demand from individuals and institutions recognizing silver as a monetary hedge, and you have a perfect storm. Demand exceeding supply, production unable to respond quickly, inventories depleting, paper markets diverging from physical reality, and prices about to do something nobody had seen in modern markets. The analyst who had been tracking all this data made a simple calculation. If silver hit $100 per ounce, which seemed inevitable within days, what happens next? Psychologically, $100 is a barrier. Once broken, once silver trades with a 1 in front of it, the sky becomes the limit. Some institutions were calling for $200 silver. Kitco recently published analysis suggesting $300 silver wasn't unrealistic, not as hype, as structural reality. Because once the paper market breaks, once the true supply deficit becomes undeniable, price discovery moves entirely to the physical market. And in the physical market, supply and demand rules are absolute. You can't print silver, you can't create it with monetary policy. You can only mine it, refine it, and deliver it. And right now, there wasn't enough to go around. The emails started arriving at mining company headquarters around the same time. Quiet inquiries from institutions that typically never bothered with metals outside of gold. Sovereign wealth funds, family offices managing generational wealth, pension funds responsible for millions of retirees, all asking the same question in different ways. Can you guarantee physical delivery? Not contracts, not certificates, not warehouse receipts. Actual metal, bars stamped and sealed, loaded onto armored trucks, delivered to private vaults. The desperation in these inquiries told a story that mainstream financial media wasn't yet reporting. The smartest money in the world was quietly panicking because they had started doing the math, and the math didn't work. At the United States Mint, something unusual was happening. Silver Eagle production was running at maximum capacity, and still, they couldn't keep up. Premiums on government-minted silver products had exploded. Products that historically traded at $2 to $4 over spot were now commanding $15 to $20 premiums, sometimes more. Not because the mint was greedy, but because blank supply, the actual silver planchets used to strike coins, had become scarce. Refineries were running 3 shifts, melting, pouring, rolling, stamping, and still back orders stretched for months. A refinery manager in Switzerland gave an off-the-record interview that circulated among industry insiders. His facility processed silver for European banks and private mints. He described something he'd never seen in 30 years. Clients were offering premiums, not for faster delivery, but for any delivery. Just get us the metal, they were saying. Name your price. The refinery had a 6-month backlog, and it was growing, because silver doesn't appear out of thin air. Every ounce has to be mined, transported, refined, assayed, certified. Each step takes time. Each step has physical limitations. And when global demand suddenly spikes, the system simply cannot respond. Meanwhile, in Shanghai, a different dynamic was playing out. The Shanghai Gold Exchange had established itself as the dominant physical metals hub in Asia. Unlike COMEX, where most trading is paper, Shanghai deals almost exclusively in physical delivery. And the premiums there were telling a remarkable story. Shanghai silver prices had decoupled from COMEX, not by a little, by margins that made arbitrage theoretically irresistible. Except you couldn't actually execute the arbitrage, because getting physical silver out of COMEX and into Shanghai required actual metal, and the metal wasn't available. Registered COMEX inventories had collapsed to levels that made traders nervous. Some analysts estimated that if just 5% of open interest stood for delivery simultaneously, the exchange wouldn't have enough metal to fulfill contracts. 5%. That's not a bank run. That's a light jog toward the exit. And yet, it would be enough to break the system. China understood this. For years, the Chinese government had been quietly accumulating physical gold and silver, not through flashy announcements, through systematic patient buying. They watched Western institutions play games with paper contracts, and they simply bought the physical metal those contracts represented. Then they shipped it east, and once it arrived in Chinese vaults, it never left. The same pattern was playing out in India. Indian households have historically been massive gold accumulators, but recently, silver demand had exploded. Wedding gifts, religious festivals, investment, Indian buyers were absorbing enormous quantities of physical silver, and like China, once silver entered Indian households, it effectively left the global available supply forever, into temple offerings, into family vaults passed down through generations. The West was slowly realizing it had made a catastrophic miscalculation. They had built their entire precious metals market on leverage and paper promises. Meanwhile, the East had been quietly draining the physical supply. Now, as Western investors woke up to the supply deficit, they discovered the metal was already gone. A currency strategist at a major European bank ran a scenario analysis that never made it into official reports, but copies circulated privately. The analysis was simple but devastating. If silver reached $100, which seemed imminent, and if that triggered institutional FOMO, fear of missing out, and if even a small percentage of paper contract holders demanded physical delivery, the entire COMEX silver market could experience a delivery default, not because of conspiracy, not because of manipulation, simply because the metal wasn't there. The system was fractionally reserved, like a bank that holds $10 in cash for every $100 in deposits. It works fine until everyone asks for their money at once. The strategist's conclusion was blunt. Prepare for a repricing event unlike anything in modern commodity markets. He estimated that in a true physical delivery crisis, silver could gap up $50 to $100 in a single session. Not gradually, over months, overnight. Because once price discovery moves entirely to the physical market, the laws of supply and demand become absolute. You can't negotiate with scarcity. You can't print more silver. You can't magically discover new deposits. You either have the metal or you don't. And increasingly, exchanges didn't. Back in North America, a curious thing was happening at coin shops. Walk-in traffic had increased 400% in some locations, but these weren't typical retail stackers. These were wealthy individuals arriving in luxury cars, asking to buy $50,000, $100,000, sometimes $500,000 in physical silver, not for speculation, for wealth preservation. They had watched the financial system strain under debt loads that could never be repaid. They had seen currency devaluation accelerate. They had watched real estate prices disconnect from fundamental value. And they had decided, enough. Time to own something real, something that couldn't be printed, something that had intrinsic value for 5,000 years. The coin shop owners were running into their own supply problems. Their distributors were rationing inventory. You can order 500 ounces, but we can only ship 200. Delivery times are now 6 to 8 weeks instead of 2 to 3 days. Premiums are rising weekly. One dealer described it simply. The physical silver market is breaking, not breaking down, breaking away, breaking free from the paper price, finding its true value. And that true value was much, much higher than $94 for anyone paying attention. The signs were everywhere. The only question remaining was, how high would it go and how fast? A veteran portfolio manager sat in his office overlooking Manhattan's financial district. He had survived the dot-com crash, the 2008 financial crisis, the COVID market collapse. But what he was witnessing now felt different, more fundamental, more irreversible. He pulled up his client portfolios and started running calculations. Traditional asset allocation models were built on assumptions that no longer held. 60% stocks, 40% bonds. That framework assumed stable currencies, manageable debt levels, and governments that could control monetary policy without destroying purchasing power. None of those assumptions were true anymore. The United States national debt had exploded past levels that economists once considered mathematically impossible to service. The dollar was being systematically devalued, not through some grand conspiracy, simply through the inevitable mathematics of printing currency to fund deficits that could never be repaid. And investors were waking up. He had spent the morning fielding calls from clients asking the same question. Should I be buying silver? His answer surprised them. Not all at once. Because even in a historic bull market, even when fundamentals scream buy, discipline matters. If someone came to him with $50,000 to invest, he wouldn't recommend putting all $50,000 into silver, too concentrated, too vulnerable to short-term volatility. Instead, he'd suggest $20,000 to $30,000 in silver, $10,000 in platinum or palladium for diversification, some exposure to copper, to gold, to other hard assets, because markets can remain irrational longer than investors can remain solvent. Silver at $94 could absolutely pull back to $80 or $70 before continuing higher. Anyone who went all in at the peak would panic sell at the bottom. So the strategy wasn't to chase the momentum. The strategy was to accumulate systematically, dollar cost averaging, buying physical metal every week, every 2 weeks, every month, building a position over time, regardless of short-term price fluctuations, because the long-term trajectory was becoming undeniable. His phone lit up with a notification, a research report from a boutique metals firm he respected. The title made him pause. Silver, $100 imminent. What happens? After the psychological barrier breaks? He opened it and started reading. The analysts predicted $100 silver within days, maybe a week at most. Certainly before the end of January, but the interesting part wasn't the $100 prediction. Everyone could see that coming. The interesting part was their analysis of what happens after. Throughout financial history, psychological price barriers created inflection points. Gold at $1,000, Bitcoin at $10,000, oil at $100. When an asset breaks through a major round number, especially one that's been discussed and anticipated for years, something shifts in mass psychology. Suddenly, the asset gets taken seriously. Media coverage intensifies. Institutional mandates that prohibited speculative positions get revisited. Retail FOMO accelerates. And the price often goes parabolic. The report cited historical examples. In 1979 to 1980, silver went from $6 to $50 in less than a year. Not because of gradual supply-demand rebalancing, because of a psychological break followed by panic buying. Could it happen again? The report argued yes, but this time, the fundamental backdrop was stronger. In 1980, the silver spike was driven primarily by the Hunt brothers attempting to corner the market. When they failed, the price collapsed. There was no underlying supply deficit, no industrial demand crisis, just speculation. This time was different. This time, the supply deficit was real. Government critical metals lists were real. Solar panel demand was real. Electric vehicle proliferation was real. The energy transition requiring massive silver consumption was real. And unlike 1980, the East was accumulating. Not to flip for profit, to hold for decades. The report's conclusion was stark. Once silver crosses $100 and holds above it for several sessions, expect institutional capital that has been sitting on the sidelines to enter aggressively. Target price range 12 to 18 months, $200 to $300 per ounce. Not as speculation, as structural repricing to reflect true physical scarcity. The portfolio manager closed the report and leaned back. He thought about the clients who had called, the ones who were just now discovering silver, who had spent the last decade focused on tech stocks and crypto, who were now panicking, wondering if they had missed the move. His advice to them was always the same. Don't panic. Don't try to time the perfect entry. Just start. If this was truly the beginning of a structural bull market driven by supply deficits and monetary debasement, then getting in at $94 or $100 or even $120 would all look brilliant when silver traded at $200 or $300. The key was positioning appropriately, not over-leveraging, not putting rent money or mortgage payments into a volatile commodity, but systematically building exposure to physical metal, week by week, month by month, moving wealth out of paper currency that was being debased and into tangible assets with intrinsic value. He pulled up the charts one more time, silver at $94.58. Knocking on the door of $100, gold holding strong above $2,800. The gold to silver ratio continuing its collapse toward 50 to 1. COMEX inventories still draining, Shanghai premium still elevated, physical markets still disconnected from paper markets. Every indicator screaming the same message. This wasn't a speculative bubble. This was a repricing. A recognition of reality. The reality that paper currencies were dying. The reality that governments had no choice but to print. The reality that debt levels would never be repaid, only inflated away. The reality that tangible assets, real assets, scarce assets, were the only safe harbor in a monetary system spiraling toward crisis. He sent an email to his clients. Simple, direct, clear. We're witnessing a historic shift in capital allocation. From paper to physical. From promises to property. From financial assets to real assets. Position accordingly, but position responsibly. This isn't about getting rich quick. This is about preserving what you've built. Start accumulating silver now. Every week, every month. Don't wait for pullback that might never come. Don't try to time the perfect entry. Just start. Because when silver crosses $100 and the world wakes up to what's really happening, you'll be glad you did. He hit send. Then he opened his own brokerage account and placed an order for physical silver to be delivered, not held in a vault somewhere, not represented by a paper certificate. Actual metal in his hands, Because he had learned something over 3 decades in finance. When everyone starts asking, should I buy? It's already too late to be early. But it's not too late to be right. And being right about silver at $94 was going to matter a great deal when it hit $200. The question wasn't whether it would get there. The question was, how fast?